Why do 90% of traders quit within their first year? Not lose money, not fail one trade, not even blow up one account. They quit. They walk away quietly, delete the apps, stop opening charts, and slowly convince themselves that trading was never for them. And that statistic alone should make you uncomfortable, because markets don't eliminate 90% of participants by accident. They don't do it through randomness. They do it through structure. If you look closely, you'll realize something disturbing. Most traders don't quit because the market is too hard. They quit because their expectations collapse faster than their capital. In the first year, traders don't just lose money. They lose belief. They lose identity. They lose the story they told themselves about who they thought they were going to become. And today, we're not going to talk about motivation. We're not going to talk about discipline cliches or never give up nonsense. We're going to dissect at a structural level why the market is designed to push most traders out before they ever mature. Because once you see the mechanism, the statistic stops being surprising. Most people enter trading with a timeline that has nothing to do with reality. They don't say it out loud, but internally, they believe something like this: give me 6 months to a year, and I should at least be consistent. That belief doesn't come from experience, it comes from exposure. They see screenshots, they hear success stories, they watch YouTube videos where results appear compressed into a few minutes of highlight reels. What they don't see is the missing data. The thousands of trades with no edge, the years of psychological rewiring, the long periods where progress is invisible. So the first year becomes a psychological trap. Early on, most traders experience random reinforcement. A few wins arrive before understanding does, and the brain connects the wrong dots. Confidence rises faster than skill. Risk increases faster than structure, and expectations inflate without permission from reality. Then the market does what it always does. It normalizes variance. Drawdowns appear. Strategies stop working exactly the way they did in backtests. Execution breaks under pressure. And here's the critical point most people miss. The market doesn't crush traders financially first. It crushes them existentially. They start questioning not just their system, but themselves. Maybe I'm not smart enough. Maybe I don't have the psychology. Maybe others are built differently. This is the moment where most traders quietly exit, not because they lack tools, but because the market has invalidated the identity they were trying to build. And once that internal narrative collapses, no strategy can save them. The biggest mistake traders make in their first year is not technical. It's architectural. They build their trading identity on outcomes instead of processes. Most beginners don't ask, "Do I have an edge?" They ask, "Did I make money this month?" That single question quietly destroys them, because profitability in the first year is mostly noise. Variance dominates. Sample size is meaningless. And yet traders judge themselves as if every result is a verdict on their intelligence. This creates a feedback loop that the market exploits perfectly. After a few wins, traders increase size. After a few losses, they change systems. After inconsistency, they assume something is broken. But what's actually broken is the time horizon. The market rewards behaviors only after they are stable under stress. Retail traders judge behaviors while they are still forming. So every drawdown feels personal, every losing streak feels like proof of inadequacy, and every system change resets learning back to zero. This is where emotional capital gets destroyed. Not because losses are too large, but because uncertainty becomes constant. A trader who doesn't know whether their edge exists cannot tolerate variance. They overanalyze, hesitate, revenge trade, or freeze. Eventually, exhaustion replaces curiosity, and quitting starts to feel like relief. At that point, walking away doesn't feel like failure. It feels like escaping confusion. Here is the truth most traders never hear early enough.
The first year of trading is not about making money. It's about becoming someone who can survive uncertainty. That realization changes everything. Professional traders don't evaluate performance the way retail does. They don't ask, did this trade make money? They ask, was this trade executed within a proven framework? Because they understand something critical. Markets pay edges, not effort. But edges only reveal themselves over time. If you look at funds, prop firms, or institutional desks, you'll notice a pattern. New traders are not trusted with capital because they're unskilled. They're restricted because they haven't yet proven behavioral stability. Consistency comes before profitability. Process comes before confidence. The revelation is this: most traders quit after 1 year because that's exactly how long it takes for illusions to die, but not long enough for real competence to form. They leave in the gap between hope and mastery, between expectation and reality, between who they thought they'd be and who they actually are. And the market doesn't chase them out, it simply waits.
To understand why 90% of traders quit after 1 year, you have to stop thinking like a participant and start thinking like a system designer. Markets don't test intelligence, they test behavior under uncertainty. And the first year is structured in a way that systematically exposes behavioral weakness before skill has time to mature. Here's the mechanism. In the early phase, most retail traders operate with what we can call fragile edges. These are strategies that appear to work in specific market conditions, often trending environments or low volatility phases. Because of this, early success is not only possible, it's common. That's the trap. The market allows beginners to experience temporary reinforcement before demanding structural competence. This creates a false attribution loop. Traders assume, I'm profitable because I understand the market. In reality, they're profitable because the market hasn't challenged their assumptions yet. Then conditions change. Volatility expands, liquidity shifts, correlations break, and suddenly the same strategy produces drawdowns that feel disproportionate to past gains. This is where smart money and retail behavior diverge. Institutional players expect regime shifts. They design systems with failure baked in. They know when edges degrade and when to reduce exposure. Retail traders don't. They interpret drawdowns as evidence that something is wrong with the system, the market, or themselves. So they react. They optimize parameters. They add indicators. They switch time frames. They chase confirmation. Each reaction increases complexity without increasing robustness. And complexity is seductive because it feels like control. But control is an illusion. The deeper truth is this: most retail traders quit after 1 year because they never build statistical trust in a single framework. Without trust, every trade feels heavy. Without trust, variance feels threatening. Without trust, patience becomes impossible. Now let's ground this in a concrete case. Take a common retail setup: breakout strategies on lower time frames. In trending conditions, these strategies perform well. Momentum carries price, stops are respected, and follow-through exists. But when markets enter range-bound or liquidity-driven phases, breakouts fail. False moves increase, stops cluster and get targeted. Retail traders interpret this as manipulation. Smart money interprets it as liquidity extraction. Institutions don't abandon their frameworks during these phases. They adapt position sizing, frequency, and expectations. Retail traders abandon the framework entirely. This cycle repeats across strategies, markets, and asset classes. And after 1 year, traders aren't broke financially, they're broken cognitively. They no longer trust their analysis, their execution, or their ability to judge progress. At that point, quitting isn't a decision, it's an outcome. The market didn't defeat them with losses. It defeated them with uncertainty without context. And that's why survival past the first year is rare. Not because trading is impossible,
but because most traders never redesign their relationship with uncertainty itself.
If you want to survive beyond the first year as a trader, you don't need more strategies. You need structural changes in how you evaluate progress. The first adjustment is redefining success. In year one, profitability is not the metric. Process integrity is. Every trade should be judged by a single question. Was this executed according to a predefined framework with controlled risk? If the answer is yes, the trade is a success, regardless of outcome. This reframes variance from a threat into data. The second adjustment is position sizing discipline. Most traders quit because emotional fatigue accumulates faster than learning. That fatigue comes from oversized risk relative to experience. Reducing size doesn't slow growth, it extends survival. Lower exposure allows your nervous system to remain functional under drawdowns, and only a regulated nervous system can learn consistently. The third adjustment is committing to a single framework long enough to generate statistical confidence. Switching systems feels productive, but it resets learning curves. Depth beats novelty. Choose one approach, define its rules, track its performance across conditions. Trust emerges from repetition, not inspiration. Finally, accept that uncertainty is permanent. Professional traders don't aim to eliminate it. They aim to operate inside it without distortion. Once you internalize this, the first year stops being a test of talent and becomes what it truly is, a conditioning phase. 90% of traders quit after 1 year because that's when fantasy expires. The illusion of quick mastery dissolves. The market stops cooperating. And without a structural framework, most people interpret confusion as failure. But the ones who stay don't stay because they're smarter. They stay because they restructure how they relate to uncertainty, progress, and time. Trading is not a sprint toward income. It's a long process of behavioral refinement. If you're still in your first year, understand this clearly. Nothing is wrong with you. You're simply early. And if you've already quit once, that doesn't disqualify you. It means you've seen the gap most never understand. If this perspective helped reframe how you think about trading, subscribe to Staro Trading. This channel isn't about predictions, it's about developing the internal structure required to survive markets long enough to matter. Master yourself, and only then can you master the markets.